Everybody to Nehemiah's e-community, analyzing your financial statements. And we're going to open up with a quick prayer and we'll get started. Oh, Heavenly Father, Lord, we come to you, Lord, to thank you, Lord, for allowing us to have this opportunity that we can share your wisdom about business, Lord, how you want us to run a business, Lord, that can glorify your name, Lord. You give us all different amount of talents, Lord, to manage, Lord. And we want to manage those talents the best way we can, Lord. Give us the insight, the knowledge, allow us to understand the wisdom that you're presenting to us today, Lord. Be with us. I pray this in your son's name. Amen. Well, thank you everybody for coming. Our quick agenda for today is we're going to be analyzing your financial statements and we're going to be talking about today's special. Okay, let's move on. I'm Tony Lowry. I'm your trainer for today. I'm a trainer and coach with Nehemiah E-Community, and I am here in Orlando, Florida. So if you're down to the sunny state, definitely stop by our E-Community Center here and stop by and say hi. And we'll give you a good cup of coffee. Now, there's 11 e-community centers around the world. Yeah, we are a global organization. And as you can see, we're on most major continents at this time. There's 11 centers, and these 11 centers service pretty much all countries around the world. And our mission is building kingdom businesses globally through local entrepreneurship, community centers. Our goal is to create a community of kingdom businesses stewards that provide products and services in a God honoring way and that contribute to the fulfilling of the Great Commission. This is so important. We sometimes we think as entrepreneurs or as people that we shouldn't be making money, but God gives us the talents to manage for his glory, not for ours. And we can't build a kingdom unless we manage those talents wisely. And that's what we're going to learn a little bit is how to analyze our businesses so we know if we're being profitable. Oops. Oh, I went fast, went too fast. But as I said, there's a global impact. There's 99 countries that Nehemiah serves. Oh, journey map. Okay. Click it once. Okay, on the journey map, Nehemiah is a social community. It's a community where you can interact with other like-minded Christians in your business endeavors. It's a membership community and it's a community open for everybody because there's free membership and then there's paid membership. And just like any other membership, if you get into the pay and the more you pay, the more benefits you have access to under the higher paid scales. We have training and coaching, so you can go to classes to learn how to do different types of business practices, or you can get a one-on-one coach to sit down and walk with you through your business. We have business support. There's accounting services, IT services, different levels of support. There's uh, so, oh gosh, my mind. There's an Excel spreadsheet that even comes with this. That's what I was trying to think of. But there's information that will support your business that's available through Nehemiah. Okay, you have access to capital. If you qualify for loans, you can get access to capital through Nehemiah. And all of this, 1, 2, 3, 4, 5, they lead up to the most important thing, this number 6, which is kingdom impact. Our job here as Christians is to impact this world for our Father, for our Son, his Son, to change this world, to go away from Satan's influence and to fall under the influence of the Son. Okay, business life cycle. Nehemiah Business Life Cycle is a series of stages that a Nehemiah business coach help entrepreneurs successfully navigate business from concept until exit. Oh, okay. This is sorry, I forgot this was I had to click on the buttons here. But we have discovery phase, and I'm just going to bring this up because we don't have a lot of time. Okay, there's 7 stages going from discovery, deciding, well, what do I want to do? Just start up, actually putting your ideas into the car and driving down that road. You're spending money now. Getting to break even, that's when your expenses, your income are equal. Profitability, now you're making money. You're putting money into your pocket. Sustainability, this is when your business runs itself. Scalability, this is when you start franchising. And then to the very end, the succession is how you're going to get out and transfer the business to somebody else. Very high level. But the importance of understanding this, if you're starting down that journey and you don't know where you are and where you need to go, you're totally lost. Understanding this helps you progress. So you don't jump too far ahead and do things you shouldn't be doing now. I was working with a young man and I tried to hold him back. He kept jumping ahead, and doing things too soon, and he lost his capital. Now he has to go back and start building up his capital to start the business. Not so much start again, but he's at a pause because he spent his capital doing things he shouldn't have done at the time in his business. He was a startup and he needed to accomplish things in his startup. So understand where you're at. Take the class, get a coach to teach you this and help you to progress. And you'll find that you will end up progressing faster. Okay. Analyzing your financial statements. My people are destroyed for lack of knowledge because you have rejected knowledge. I also will reject you from being priest for me because you have forgotten the law of your God. I also will forget your children. This is from Hosea 4:6. Lack of knowledge. That's what destroys us. We need to learn. We need to take the time to, to learn about our businesses and what makes the business profitable and run. Very important. Now, I have an icebreaker question. In reviewing the following income statement, state 3 things this business can do to make more money. Among the 3, which one is the most important? Okay, here we go. We got sales, 50,000. Cost of goods, 20,000. Gross profit, 30,000. Wow, he's got a good profit. Operating expenses, 10,000 rent, 15 salary, marketing 2,500, transportation 1,000, supplies 1,000, interest 1,000, total expenses 30,500 minus 500. You stay in business. If you keep doing that, you're going to lose all your capital, and next thing you know, you're going out of business. So we need to sit there. We need to fix what is going on in this business. Now, I don't know if I get audio feedback here, but I'm assuming this is what we're broadcasting. So we sit here, we look at it. Okay, couple things. Gross profit, 30,000 off 50, that's 60% gross margin. Well, if I got a 60% gross margin, if I bump up my sales by $833, 333 goes to expenses. I get 500 coming back, and boom. Do I have chat? Greetings. Sorry, thank you for joining today. All right. So I have $500 more of extra profit by doing $833 more in sales. So that's one method. That'll come all the way through, and boom, you'll be at zero. You'll be at break even, just with $833 to sell. Or I can reduce my cost of my goods by $500. Depending on your market, that might be doable or it might not be doable. Cost of goods it's driven by which market you're in. You have to understand what is normal for your market. This is where knowledge is so important. If you don't understand your market, you don't know where you're out of whack on this, on your sales and your expenses here. So you could rent, salaries. Salaries is something you can adjust. Rent is pretty well fixed unless you go spend the money and move somewhere else, and there's a lot of different costs. Salaries, Well, you can lay off someone. Not the best thing to do if you want to grow your business at this time. So to me, really, there's two areas that you could really uh, improve this is bring up your sales or lower your cost of goods. If you lower your cost of goods, every dollar you save off of cost of goods will go to the bottom line. So I can reduce cost of goods 500, or I can increase my sales by 833. So there's the two obvious things. And then I'm coming down to my operating expenses. I could figure out what in that operating expenses is out of whack. Is my salaries too high? You know, if I'm in that salary category, maybe I need to reduce my salary as the owner. These are some areas you can think about. Okay. Now our objectives is to state the three purposes of the financial statements. Develop an income statement, develop a cash flow statement, and develop a balance sheet. Okay. And use financial statements to make business decisions. Well, we can't make business decisions unless we understand each of the statements and understand the information in the statement as it pertains to our business type. I want to make that perfectly clear. You need to understand your industry that you're in, because what's good in one industry is not good in another industry. Just to give you an example, I worked in an industry where 30% gross margin was nominal. Another division in our corporation was 10%. 30 and 10, the 10% guy has to sell 3 times as much to make the same amount of profit that I was making. And the people in the 60%, like our previous example, that 10% has to do 6 times the sales to make the same amount of gross profit, just to give you an idea. Okay. So you have to understand your market. And that's where doing research about your business and business type is very important. And a good coach can help you with that. So the three purposes of financial statement, Proverbs 27:23 through 24. Oh gosh, I'm doing so good on time. I was rushing through this, everybody, and I'm being good. Well, anyway, be diligent to know the state of your flocks and attend to your herds, for riches are not forever, nor does a crown endure to all generations. You know, riches are not forever. If you don't manage them, if you don't keep an eye on them, they will flee away from you. So, by understanding the state of your business, your flock, and watch over your business, your herds, that's how you maintain your riches. It's so easy for people once they start making money, and I've seen this. Person got their first biggest contract uh, at Epcot Center at Disney World. This was a long time ago. They had their construction company. They thought they were making money. They went out and bought themselves a Mercedes Benz, and they couldn't pay their employees' salary. The employees walked away, and the business went bankrupt. They weren't watching their herds. So the three purposes of financial statements: to know the state of the business, to make sure there are enough resources in time of lack, exercise wise stewardship over the business. That one person construction company at Epcot Center, they weren't very wise stewards. We have three statements we're going to use is the income statement, cash flow statement, and the balance sheet. Okay, now an income statement. Proverbs 14:23. In all labor there is profit, but idle chatter leads to poverty. Now, when we all get around the water cooler and talk, that's kind of the proverbial thing we're talking here. The chatter, people just talking. If we're doing that and not managing our business and not working, we're not going to be generating income. Our focus needs to be into doing work. As Christians, we can have a very friendly environment, Christian-like environment, but we also need to be in an environment where we are working. because our job when we're at work, if we're working for someone or if we're working for ourselves, is to generate profit. And that's what our Lord has given us. He gives us talents, which we can say is money, or actual talents, our abilities, our skills to manage for his glory. If we're not out there using our talents to the best ability, working, because it all comes back to the original sin with Adam, we have to labor and toil. That's what the scriptures tells us. It's not our job to be laying back and expecting wealth to come pouring in. No, from the original sin, we as people have to toil and labor. And from our labor, and it can be very enjoyable, we can generate money and profit for the company, and we can glorify the kingdom through that. But if we're at the water cooler talking all day, it won't happen. I'm sorry. Now, an income statement. An income statement is a financial statement that reports the financial state of your business from an accounting point of view over a specific period, typically monthly, quarterly, yearly, or all three. I typically do a monthly income statement, and then at the end of March, I do a combined quarterly one that shows what we did for the quarter versus what we did each month, and then an annual one. I do them all because obviously you want to see what you're doing, where you're up to date, where we are each quarter, where we are each month. You want to know where you're at because you need to know if your income, if you're meeting your, well, cash flow helps you to meet your bills, but you need to know how profitable your business is. Keeping an eye on your business, your income, but it allows you to measure your profitability or your loss, and that is so important. So the key questions from an income statement: what's my total income? What's my total cost of goods or services? What's my gross income? That's your income after you take your cost of goods or service from your income. And I like to look at it as a gross margin. That's the percentage. What is the total operating cost? And then after that, you would have your operating income. So you want to know that as well. Then what is my business tithe? How much am I going to tithe? Well, after you take out all your operating costs, you have all your income, all your cost of goods, all your costs and everything, you're going to come down to that, your total, it'll actually be a subtotal, but it's your total profit at that point. And then you're going to say, based upon that, this is profit before taxes and tithe. You're going to determine what your tithe is. And then after the tithe is where you take your taxes, you calculate your taxes. And then from there, you're going to have your net profit. And that's after your tax and your tithe. That's the bottom number that you walk away with. So here's the good. We have our statement there: sales, cost of goods, as you're going down, as I explained them, and your operating expenses, that's your salary, that's your rent, that's your advertising, any other depreciation, all the expenses for operating your business. And it's very important to understand the cost of your goods versus your operating expenses. And the thing here is cost of goods. If you didn't sell the product, you wouldn't have that cost. So all the material that went into the product that you're selling, cost of goods. If you have to receive the products in to make your product that you're selling, if you're doing an assembly, I have to receive in the product. So I have labor there. So you need to know if your labor related to cost of goods. When the goods come in, I have quality inspectors inspect it to make sure they're meeting. If I didn't have goods coming in, I wouldn't have quality inspectors inspecting it. So those quality inspectors, when they're checking stuff coming in and they're checking the manufacturing process of what's being done, their salary is part of cost of goods, people. Some people forget that. That's cost of goods. Then the salary down below, it could be overhead. That's your accounting department on your operating expenses. That's your marketing department. That's your executive salaries. That's all the people who are not directly selling the products or making the products to sell. All their salary is under operating expenses. So there's actually two areas that salary is recorded, and sometimes people forget that. So anyway, so you come down, you get your total operating expenses, you subtract the two, and it's your profit before tithe, or this, a lot of times they'll call it your operating profit, and then you take your tithe out, and you have determine your how much your tithe is, and then your profit before taxes, and then you have your taxes based on the legal structure and tax bracket. This is really complicated here, because if you're trying to determine that, there's a lot that's involved in determining the taxes, because as you need to know, where do you have any other businesses? Do you have personal outside income? Because depending on your tax structure in reference to your business, how that business is going to be taxed. If it's part of your income taxes, then you need to know is, remember, we're in a graduated tax. So the first amount of money, first 10,000 is taxed at 10%. The next 40,000 may be taxed at 12%. I forget what the graduations are, so please don't take these numbers as guidance. But it goes all the way up to 34% taxes, depending on where it is. So you need to know where your business is in relationship to those taxes. Because if you had 4 businesses and they're all Corp Cs, so they all come to your income, and if you don't know your tax brackets on all this income, you could end up taking out too little taxes. Be aware. So get with your coach. Your coach can help you about that, knowing that. And here's an example. What we see here is, okay, they got $10,000, 4,000 in cost of goods, gross profit 6,000, 60%. You will hear those numbers, gross profit margin, because a lot of investors will look at percentages, not dollars. They want to know is if your business is operating within the margin for your industry on percentage. And as you go down, as we can see the side, okay, $3,000 salary for $10,000 sales, depending on the industry, that might be good, that might not be good. We don't know. But you can see the high percentages on some of these areas, good areas to look at when you're looking to reduce cost. And coming down, they had $1,500, 10% tithe was $150, which is 1.5% of the top level. So these percentages all reference to the sales. So we don't necessarily give 10% of our sales, because if our only profit before tithe, it was $1,500, we would be giving $1,000 away. We could be crippling the business depending on how much profit before tithe that we have. So typically your 10% is profit before tithe, because the Lord allows us we have expenses to make the product that we're selling, and we take those expenses out. Now, if you're in a purely consulting type practice, we did 10% right off the top, and we still do, because we're more of a consulting practice. So we feel like we can do that, and that's giving more than what the Lord asks of us, but that's what we do here. Okay, let's move on. Okay, developing a cash flow statement. Now, Proverbs 10:5, he who gathers in summer is a wise son. He who sleeps in harvest is a son who causes shame. Yeah, we need to be working when the harvest is in. We need to work hard. If we leave it out into the field, what happens? It decays. Animals come in and take it away. Things can happen, and next thing you know, that bountiful harvest, we lost half of it out in the field because it got old. When the work is there, we need to work hard, and that's what I get from this. Okay. So we want to develop a cash flow statement, and it's a financial statement that reports the company's inflows and outflows of cash over a specific period. All right. Now, we're talking about a specific period. Usually you do this every month because you've got goes in us and goes out us. You got to pay your bills every month, and you got money coming in every month. And normally a cash flow statement, even though you do it for a whole year, you can do it. You're typically looking that month and you'll project your cash flows forward based upon what you know. At least that's what I do. So it allows you to know how much cash is going in and out of the business at any given point in time. Well, that's the projection part of what I'm talking about. So the key question answered with your cash flow: what is your beginning balance? Do I have a positive cash balance? When will I need cash? And is my cash flow positive or negative? Well, your bills come due. You have certain fixed bills. Okay, the rent's the first of the month most times. Payrolls every week, unless you do a monthly payroll or a bi-weekly payroll. So you know some of these things that are going out on particular time. Your power bill comes in, let's say, on the 15th of the month. Your water bill comes on at the 30th of the month. Just all these different expense. Your vendors send you bills payable in 30 days at the first of the month, so you need to have them paid by the end of the month. So you have all these trends and all this history. So this is how you're projecting your cash flow forward. Okay, so here we got a basic cash flow statement. Starting balance, your cash in items, your cash out items, total cash out, your ending balance was a positive and negative, and your total cash in and out. All right. So here, this is projecting forward. So we start with $0. Okay. Start brand new business. Day one. Typically, if I was starting a new business, starting cash balance is not zero. You need money to start a business. So you typically invest in, you put 20,000 in, 10,000, depending on whatever you have, because you're going to be starting to pay bills. So your starting cash balance, even though it's shown here as zero, typically for a business, depending on the nature of your business, okay, whether you're manufacturing or you're just doing professional services, you're going to need a starting balance to pay bills. So you're going to get some capital and you'll start off with a balance. But here we're going to reflect a pure cash flow of the business with no initial investment. So your starting cash balance is zero, $5,000 in sales, no collections, no investments. So total cash in is 9,000 this month. Great. But my outgo is got a $3,000 salary. As you notice, going right across the board, the salary's the same, the rent's the same, my advertising budget's the same, and this other category, those are different items that just could come in. You don't know. Now, typically, if I'm projecting, we have this is the model here, but sometimes when I'm doing my projection, I actually budget for other. I like to do that. But here I'll have an amount every month. Here they're only projecting another cost, something we don't really know about, of that month of $300. Cost of goods sold. So sales. So they're starting out with cost of goods of 1,500, and all of a sudden they jumped up to 3,000. I would be really concerned about that. Oh, no, never mind. I see it. Okay, and you'll probably ask why. It's 3,000, and I'll explain it to you in a minute. The tithe, same amount each month. Owner's draw, same amount. Cash out, we're showing that it steps up the following month. Then the ending cash balance of 2,250. So an ending cash balance of 2,250 plus, if you put the tithe in, was 2,500, which 10% of 2,500 is the 250. So they backed in that tithe, and it looks like they're going to keep it at $250 every month. They're going to fix it in. So they have a positive cash flow of $2,250 at the end of the month when they take out all the expenses. When they come into the next month, that cash item 8 goes back up to month 2 for item 9, $2,250. They've got $5,000 in collections and along with the sales. Well, that collections is product they sold the previous month, okay, that they didn't get paid for in that month. That's what your collections are. So now, because they didn't get paid, their cost of goods, if you drop down, that's where that cost of goods went up. So they collected or they paid out that other 1,500 the following month because maybe those sales were sales that maybe they made the sales, but they actually didn't build the product until the next month. Anyway, it came in, those sales came in the next month. And as you see that, they're taking sales as actual cash in because this is cash flow. So they really sold 10,000 the first month, but they only collected 5. That other 5 is collected the following month because this is cash. This is not sales like I did $10,000 in invoicing. This is I did 10,000, I invoiced 10, but I only collected 5,000 of it in the first month. And then the next month at 5,000, I did 10,000 in sales. And that's why it's only 5,000 income and 5,000 collections each month. That's why your cost of goods doubled on that first step. Just to clarify that, if anyone sees that, it goes, what happened here? Okay. And they're maintaining their tithe. So, but their cash flow is roughly about $2,000 a month. And you want to keep that cash flow going because you sit there and they have total cash. So they're roughly running about $8,000 a month in expenses. Okay. You want to have as a business, depending on the nature of your business, at least you want to build up 6 months to a year of cash reserves. I mean, it just depends on your industry. I worked in an industry for many years that we would go through 6 months to a year of really no work, of real work, little income coming in versus the $100 million projects that we get. Those, it was like a roller coaster ride. We get the big project, we work on it for a while, and the boom, it's done, and then it's not that much income. And usually what happens is if we don't get anything coming in, we start laying people off, we start cutting expenses, and then that next big job. But in the meantime, we always have those little jobs that help us. That's where that reserve capital comes in. So you have to know your business to know how much reserve capital that you need to maintain in order to pay. Because if you don't have it, now you're going to the banks and you're borrowing and you're paying now interest for the money. And the banks may not loan you the money. You have to be aware of that. All right, developing a balance sheet. Deuteronomy 8:18. You shall remember the Lord your God, for it is he who gives you power over wealth, to get wealth, that he may establish his covenant, which he swore to your fathers as it is this day. Okay. Now, a balance sheet is a statement that lists the assets, liabilities, and net worth of a company at any time. Enables you to know what the business owes, and is worth. Okay. The key questions is, what are your assets? These are things that are worth money. It's not necessarily, it's like the car, it's the building, it's the appliances. But assets could be this guy right here. So intellectual knowledge, that knowledge, if it's proprietary, it's also considered an asset. What are your liabilities? Well, it's all the money I owe everybody else. And what's your net worth? Well, you take your assets minus your liabilities. Guess what? That's what you're worth. All right. So we got the current assets. Okay, that's your current on the one side. You got your current assets and your current liabilities. You got your so on the asset side, we have cash, accounts receivable. That's people who owe you money. That's the inventory. That's all the product we have back there in the warehouse. When we add all those, that gives us our total current assets. Then we have our fixed assets. That's the real estate. That's all the equipment. That's our trucks for delivery. That's uh, any other type of fixed asset off the top of my head. I can't think of any, but your building, your any type of equipment, refrigerators, freezers, um, uh, manufacturing line, pools. Those are all considered fixed assets. And then you add them all up, and that gives you your total assets. Now on your liability side, you got the money you owe your people, your accounts payables. You bought all that product or that everything to make your product. You had to buy all the raw material. That's the term. You had to buy all that raw material to make your product. So you owe those people money. That's accounts payable. You got notes payable. Well, you borrowed money. Well, you got to pay those back. You got contracts payables. Well, maybe these are like services or any type of contract that you agreed to pay back. You got to pay that money. These are all liabilities. You add them all up. That's your total current liabilities. Now we have owner's equity. Hey, it's a liability to the company. That owner, you owe the owner of the company. Common stock. It's the owner stock. It's all the stockholders for the company. Particularly if it's traded stock, you add all this up, and you get your total owner's equity. So your assets should equal your liabilities plus your equity. You can add, if the two are not equal to each other, there's a problem. So number 5, there's an equal sign in there. Number 5 on the left side should equal number 5 on the right side. And if they don't, you made a mistake. All right. Developing a balance sheet. Assets equal liability and equity. Okay, here we have actual numbers representing what I was talking about. As you can see on this, I was just mentioning here on the very bottom, total assets are 28,400. They equal the liabilities plus equity of 28,400. Boom, it's balanced. So most likely it's filled out correctly, unless countering mistakes on both sides. But hopefully that didn't happen, because it would require 2 mistakes of the same amount in order to balance it. I have seen that happen, but I'm just saying, normally if you see that, it's correct if you're doing your own finances. So they got $6,400 in cash. That's how much, like I said before, the cash that company has at the time they were doing this. Because this is not something cash. We're going to state that this is the balance sheet as of August 14th, 2025, because cash varies every day. So some of the inventory varies, accounts receivables vary. So you have to pinpoint a date that you're analyzing, or it doesn't have a real meaning. Okay. A lot of times when a company reports, it's at the end of the year or the business year for the company. So, but there will always be a date. If you ever look at it, you should find a reference date on a balance sheet. So cash 6,400, 1,500 accounts receivable, 4,500 inventory. That's 25,900. No real estate, but they do have an investment of $2,500 on equipment. Now, there's one thing I don't see on here, and that's depreciation. Now, remember, equipment does depreciate, and it's also reflected on here. But that's more like if you're getting into equipment that you would depreciate. You got a vehicle, you're going to start showing depreciation on here and tracking it. Okay, so that's something I see that's mentioned. But this is when you get more and deeper into your balance sheet, when you start recording these other parameters. And depreciation gives them an idea, your investor an idea, by the way, of how old your equipment is and whether or not needs to be replaced. Because if it's 100% depreciated, it usually means it needs to be replaced. But anyway, financial statement to make business decisions. Matthew 13:23. But he who receives seed on the ground is he who bears the word and understands it, who indeed bears fruit and produces, some 100-fold, some 60, some 30. Wow. You receive, if you put the seed in good soil, if you put your business into good practices, if you're productive, if you're making good business decisions, your business will be prosperous. And you need to make decisions based upon what you see from your financial statements. Okay. One of the first things you look when you start off at a business, after you understand all your expenses, is you do a break-even analysis. This is basically everything coming in and everything going out. You want the two of them to equal. So your total income minus total expenses equals 0. That's considered your break-even analysis. Now, they talk about here break-even analysis with monthly fixed cost. So you take your monthly fixed cost by your gross profit per unit, or your what we were talking about before. You can go up there and you can calculate. That's where percentages would go in. So if you took gross profit per unit or your gross margin, which is the percentage. So if for the 60% gross margin that we had for the business, $50,000 worth of sales, $20,000 worth of expenses or cost of goods was 30,000. That 30,000, I said, it was 60% gross margin. So based upon a 60% gross margin, if I had a fixed cost of $25,000 a month, I divide it by that gross margin. That would be $41,700 in sales I would have to do a month. Again, this same thing here. I like using percentages, but you can do dollar amounts to determine units of sale. Here, they're talking about gross profit per unit. So you're going through and you said, okay, that $50,000 of sales was so many units, and that minus that 20,000 or that 60% of those units. Again, that's back to that margin. So if every unit was $1,000, 60% is 600. I would sit there now to look at it and say, okay, for those costs, 25,000 divided by the 600, because we said there were 1,000 at 6%. That meant I needed to sell 42 units a month to break even. 40,000 divided by. Oh yeah, because before I was showing, yeah, because they made a profit. So they would need to sell 42 units to break even. There's different ways to look at the break even now. So you can look at it per unit, or you can look at it over sales. It's relative to what you're producing and what your market is. If I'm producing widgets and I'm selling the same widget every month, I'm going to do my break-even analysis based on the number of widgets sell. If I'm selling all these different products and services, I'm going to do my break-even analysis based upon sales. Okay, so it's just you have to know your industry in order to determine how you're going to calculate your break-even analysis. So here they got variable costs. You got your monthly fixed cost divided by your gross profit per unit minus your estimated variable cost. So all they're doing is, okay, I have some variable here that I have no idea what it is. So I'm going to estimate it, and I'm going to take it from my gross profit per unit on this analysis, and then divide it into my fix, because my fix doesn't change, but I have a variable part that I don't that I don't know really a lot why it varies per month, or it just these random expenses come in and I'm trying to estimate. That's what the analysis. But even that, you should know. You need to understand why I having a variable cost. Because it might be variable, but you should know what those variables are and why they're variable. Because that way you can do a better estimate of those costs going forward. Now, return on investment, ROI, that's a biggie. You know, people want to know, well, if I put in $5,000, how much money am I going to get back? Are you going to give me $5,001? Or are you going to give me $6,000? Big difference. People want to know. They're looking for the higher ratio analysis, you know, debt equity ratio. Banks, oh, that one's big for banking. They want to know what's your total liability divided by your equity, because that'll determine how much money the bank's willing to lend to you. And your turnover ratio, that's the cost of sales and your average inventory for the period. In other words, how often does your inventory turn over? It's an estimate, because some items in the inventory may not sell. If you got let's say you got a turnover ratio of 2.5 months, there may be some things that are in your inventory for 9 months a year, and other things that go out every month. That turnover ratio is an average. Okay, that's the main thing to understand. How quickly your inventory turns over. So all these items are they're important to know, but they're really relative to your industry. You need to understand them for your industry, how they pertained. Okay. Well, the business life cycle, as we said before, in great class, I would encourage everyone to either to take this class, particularly if you're starting a business, or if you're in your business, and gosh, really at any stage you should understand this. But you need to know how to progress along, because with all this knowledge and information on the statements, if you don't know where to get to the next step along the life cycle, you will end up investing and putting your time and money into the wrong areas. So understanding this, getting with a coach or taking a class, if you're the entrepreneur and you just want to do it all yourself, you know, more than one brain is usually better. If we get a coach in there, he can help us to see things we're not looking at. So if you're the entrepreneur, open your eyes to having good people around you. If you go get a loan, they want to know who your advisory team is, because the bank may not loan you any money if you're by yourself. That advisory team, one of those members is your business coach. You have a financial coach, you have a banker, you have different people. But if you don't have a business coach, sometimes those bankers, they're gonna look at you a little more skeptical if you don't have people that are there to support you in running your business. So just to let you know. But this business life cycle, um, they have a free tool for analyzing your financial statements. Now go to seminar resources, nehemiahecommunity.com. Really don't have a lot of time, but that brings up, there's a profit and loss template there that you can use that we talked about. And there was another one there too. I think it was, and I don't have it up. I thought I had it up. Okay. But anyway, there's a profit and loss statement there. And I believe there were two statements there. I'm sorry. I thought I had it up. But you can get this. It's a free resource. I encourage you to download it and utilize it as you need. Follow the instructions. Now remember, there are certain fields with formulas in. If those formulas are not locked, please don't delete the formulas or you're going to mess it up. So always keep a copy or keep it the original and then make a copy, work from your copy, keep your original as a template, Do not edit template, because if you inadvertently delete something when you're working in it, and if the cells are not locked, you can end up deleting formulas, and then it messes up your calculations. So basically, there's an old saying, garbage in equals garbage out. If you mess up the formulas, you're just going to get garbage out. Okay? So don't edit formulas. If you think it's wrong, call Nehemiah and get support. Ask your coach, call technical services, but ask someone about it, because there may be some details in there that you're unaware of that's being taken in consideration in the formula. Okay, and then, well, we have the forum discussions, seminar forum, nehemiah.com. Please utilize the forum. You could sit there and ask questions, get answers back. Forum discussions, all part of that community development, that social community effort through Nehemiah. So share in this forum. So share your key takeaway from today's EC seminar topic, analyzing your financial statements. Elaborate on how the topic has challenged you.